Hi, thanks for joining us for another great video here at Street Smart Options. I'm Jim Bunker, and I'm here with my business partner, Jonathan Sherman. And folks, today we're talking about options trading example. And what we're going to do is we're going to give you an example of an options trade, and Jonathan's going to kind of walk you through what we're looking at and why we would put this trade on. So keep in mind, folks, at streetsmartoptions.com, you can always come over and join us as a free member over at the group, and you'll get more information there. You're also more than welcome to join us in our paid area where we actually instruct people, and we have a full entire course about how we trade and how we've been able to be hyper successful in the market. So with that being said, I'm going to turn it over to Jonathan Sherman. Go ahead, Jonathan.
Thanks, Jim. Yeah, today we're going to talk about Caterpillar, and we're in a market right now that is, and this is the S&P 500. We're in a market right now that is a little bit overextended to the upside on a rebound after a tremendous sell-off, actually a bear market sell-off, which was a definition of a bear market, which is 20%, 20% sell-off in the S&P, which ended in December. But we've had this straight-up rebound since then. And now our cycle indicators are saying the market is overbought and is due for a pause. So we're looking for a trade that's going to benefit if the market goes sideways or down a little bit over the next 3 or 4 weeks. And so basically you want to look for a stock now that has good liquidity in options, in the options trading, that is underperforming the market and should continue to underperform and do poorly if the market goes sideways or down. And so we're looking at Dow Industrial 30 stocks, and we're looking at Caterpillar. And Caterpillars, as most people are familiar, make the big tractor, the big yellow tractors that are used in construction and farming. And so the stock has been underperforming the market since since January 2018. The market has rallied and then fell a little bit, but Caterpillar has actually gone down. It's actually down from the beginning of 2018. And it's been trading sideways, consolidating, but I wouldn't expect it to do much right now. With this recent market rebound, you can see that the S&P rebounded a whole bunch here, and Caterpillar just did nothing, right? It just kind of blah, right? It's still trading under its 200-day moving average and also under its 50-day moving average. So it's just in this lazy little trading range. Wouldn't expect it to do anything over the next 3 or 4 weeks. And so if we can find a trade that benefits from this action, we might make some money. So in a bear put spread, we're buying a high priced put that doesn't have a whole lot of time value in it. So something that's that's deep in the money, high priced, like maybe the 145s in this example, and then we're selling the 135, which has more time value because it's closer to today's trading range, to today's strike price, I should say. So today it trades at what's the thing close at 128.60. So if we sell the 135s and buy the 145s in the puts, we're going to capture any time premium between there as long as the stock trades below 135 in 3 or 4 weeks. And so it turns out Caterpillar has that opportunity. And if we look at the options ladder in Caterpillar, we can see for the 1 month out puts, March 15, 19, 33 days, and we're looking at the puts here, and we're looking at the 145, 135. And so if we buy the 145, and we'll have to buy it, so it's going to be in this range here, about 15. Let's pay about 15.85 for it. In this, we'll do a bid on the spread so that we try to get the best price we can. But we'll probably end up paying about 15.85 for it, and then we'll sell it, and we'll sell the 135s for about 7.8. Get in this range here, and so let's figure out what that comes to using our options trading calculator that you find on our website, member.streetsmartoptions.com. going there, and I'm looking here now at the bear put spread calculator, and I've input the data already, assuming we have a $500,000 portfolio, and we're going to take a max position size of 2%, and you can go a little bit bigger with this. I personally think this is a pretty low risk trade. And so, we could maybe push this up to 3% if we wanted to. And so we have here, and it's Caterpillar, and we're going to look at the expiration. Oh, I'm looking at the wrong date. So let's put this would be 3/15. So let's put that in there. Let's put that in the calculator. 3/15 is the expiration. Okay, so looking at the 3/15 expiration, we have a high strike of 145, a low strike of 135, and the price of the high strike option is 1635. The price of the low strike option is 780. Well, it's actually 1635 is incorrect. Let's go take a look again at our ladder here. 785, 145. We're going to end up paying about 1685. So let me see if that was the right number. 1685. Okay, and 785. 1685 is what we're going to end up paying. We're going to end up getting 785. So that comes out right. So you look at that, and the net premium is $9 on this, and our max potential gain over the course of the next 33 days is 11%. And we like to look at what that is annualized. And if it comes out over 100%, we're pretty happy. And in this case, the max annualized gain is 126%. So this is a decent trade. Now, we're assuming that over the course of the next 33 days, we're doing, it's a probability-based trade based on where we are in the market. We're basically making a probability-based bet that this will not trade over 135. And we like this trade because if you look at it, the declining 200-day moving average right now is sitting right above 135, right around 135. So this is a pretty reasonable trade, also given the fact that we're in February, and February to March timeframe historically is not a great time in the market. So I wouldn't be surprised just from a calendar standpoint that the market is weak in here. And plus, it's confirming on the cycles that we're overbought on these cycles here. So, and it's bumping into the 200-day moving average. So this is a pretty good options trading example. It's a bear put spread, and it's a high probability bear put spread that you can do right now in the market. And now one thing you want to look at before you put on these trades is when earnings are. You don't want to carry this trade through earnings. You want to take that risk. So looking at Yahoo Finance, we can see that the earnings for the company, they reported already. The next earnings won't be till April 24th. So we have no worry about earnings in this trade. So there you go. There's our options trading example.
All right. Fantastic, Jonathan. Thanks for that. So, folks, again, if you're not a member of our Facebook group, you are missing out on opportunities to get information like this and fantastic posts that we put in our group for free. That group is located at Facebook. All you have to do is search for SSO and click on the Street Smart Options link that you find in your search, and you can go directly to the group and join for free. If you're watching this on our YouTube video, please consider subscribing to us. All you got to do is hit that subscribe button and then hit that bell icon when it pops up so you get notified every time there's a new video that's posted, so you won't miss timely information like this video. Folks, if you like the video, please consider also giving us a thumbs up. Always helps with our optimization of our channel, and we appreciate you watching our video. Have a great day.